Shabbat.
Hey, everybody. So we're back and we're just going to talk more overall about Systems Academy and discuss questions and really just talk along the way.
Yeah, there's always much to talk about. So maybe jump in.
Yeah, and feel free to ask questions just at any point. We're going to start doing these more regularly, 15, 20 minutes here and there, but feel free to ask any questions along the way.
Imagine BH maybe around with some good questions.
Oh, yeah. So let's see here. James, you were going to talk, you mentioned you were going to discuss some about the market cycle.
Yeah, and perhaps how one during the system design process kind of thinks about the system that they would deploy at different times in the market cycle. So let me show my chart.
Sure.
And so I'm going to share a chart which has Ali's breakout indicator that he wrote for Systems Academy. So this is, and I'll discuss it. It's basically what I have is or what I showed in previous streams was my modified version of it. But this is his original code.
Mm-hmm.
And so I've translated this from TradeStation from Easy Language into PineScript. So this is in TradingView. So if someone were developing a system, one of the things that and one of the questions which I've gotten a lot is, where do we start? Do you have a place that you suggest students begin? And it's usually a breakout system. And this does not mean, necessarily buying the close of breakouts and just entering on strong bars. This is
so why a breakout system?
Because it covers a larger portion of the market cycle until you get a reversal, which is typically a late or a reversal, which is tradable for more than a scalp. Because so if you have if the market cycle is starting from a breakout, so the breakout is what defines the market cycle. All market cycles begin with a breakout, and then you have breakout, channel, trading range, and different degrees of that. And so if the first system you build covers basically the range of the ways breakouts can be expressed, then it covers a lot of territory and can generate many signals during the day. And hence why Ali focuses on breakouts when he starts talking about the starting point for students in Systems Academy and why he wrote this code. So if we look at, especially bar one today is an outside bar, but it's an outside bar breakout that is significantly larger than or significantly higher than the previous swing point, and it is much larger than the previous bar 81. So odds for getting follow through. It's outside bar, green bar, but then you have follow through here, and there's no reversals. There's no tradable reversals, right? The only reversal bar is an inside bar on 4, and then subsequent breakouts again. And then your only bear breakout bars are outside bars. So again, lower probability for tradable second legs generated from those. So the code keeps you focused on the way the market cycle is developing, 2 strong breakouts and weak pullbacks, from outside bars. If you're looking at your system through the lens of the market cycle and you're prioritizing breakouts to generate your signals, then you're not going to be looking at any, sells in any of this. So it's keeping you on the right side of the market pretty efficiently.
And I want to say, James, just real quick, something about that. And when you start thinking through the market cycle as a whole, there's a really important and subtle reason as to why you want to focus on breakouts. A breakout is, as James said, it's the initial start of a market cycle. Breakout, you get a second leg, that's a channel phase. Usually you get 3 legs up, and then the market evolves into a trading range. The problem with breakouts is if you fade the breakout, you're going to get trapped into a losing trade. Therefore, if you look at that bar 1 that James is pointing out, the reason why breakouts work is you have trapped bulls and bears. You have bears who are trapped into a losing trade and they're forced to exit. And they're going to cover pretty quickly if the market does not pull back. And James mentioned there was no stop entry sell that triggered during those first couple of bars. And that'll cause traders to be forced to exit. That'll cause bears to force them to have to buy back their position at a higher price. It'll also cause bulls to be forced into buying high. But one of the reasons why breakouts work is if you're a limit order trader doing the opposite trade, you will be forced out of the trade. So if you want to become a good limit order trader, you have to understand where strong breakouts are occurring. Because on days like today, if you sell and scale in all the way, you're going to be trapped into a pain trade.
And to that point, actually, what's interesting here is that if someone fade, and actually, Ali has talked about this a number of times, that there is a statistically significant system that you can develop based on fading strong moves on the open, because they overwhelmingly generate reversals. But if they don't, then they're doing the low probability thing, and they're going to go significantly farther than one would imagine. And today, small pullback trend is a good example of that. But here, so if someone did fade this and then sold higher, then they got out break even at yesterday's high. So they were able to get out without if they managed the trade properly, they were able to get out without a loss. And even if they scaled in and held, thinking that this was not a strong follow through, even if they sold again here, they could still get out break even at the close, or even with a nominal profit. But this outside bar, in likely bears getting out, and that was the end of the bears' attempts to sell. So to your point, Brad, I mean, I think that being able to see that the one side getting trapped into their trades and wanting to get out as kind of the underlying pressure between behind this consistent buy bid that we had all day today. It's a great example of that.
And James, let's talk for a second about bar 15, because you said, well, really bar 13. If you can point, it's the orangish red bar.
Bar
13.
13
15
years
in a second, but bar 13 is an outside bar, right?
That's 11. Sorry,
I'm sorry. That is 11. You're right. So 11 is a downside breakout. And when we look at bar 11, we can tell that obviously on some time frame, if we go to a 1 minute chart, it's a pretty big bear breakout, right? You don't have to go to 1 minute chart, but if we look at it, it was a breakout that probably should have gotten a second leg. And if we see what happened a few bars later on 12, 13, and 14, what would you? So what would you do? Yeah, right there. If you sold the close of that bar, or sold during the breakout and scaled in, notice what happened on bar 15. 15 is breaking out to the upside. So what it's doing is it's trapping any of the bears who sold and scaled in. And one of the problems with strong trends, especially small pullback trends, is right there. You get bear breakouts that appear somewhat violent that can last for a bar or two, and then bulls get squeezed, or the bears get squeezed in this case, and then the market drifts higher.
And then the quick bears actually were able to get out break even if they were fading that. If they weren't quick, they did not get out.
And this is one of the reasons why Al talks all the time about waiting for a trend line break of a move and waiting for the move to go under the moving average. Because even if you look bar 39 just barely dipped below the moving average you have. And that's not adequate enough to make it an actual downside bear breakout.
And it's not a strong close either. I mean, it's a bear bar,
Mm.
but it's not a strong bear bar by any stretch of the imagination.
But yeah, and even the very next bar, bar 43, is a great example of what you're talking about with breakouts. Imagine selling the close of 43 and scaling in.
Yeah. I mean, and actually, this is a great case for how to think about leg count too, because anyone who was selling, I mean, and to be fair, this wedge did get its expected correction to the leg two lows. So
And,
yeah,
and maybe we James, we should talk. What when you say leg counting,
hmm
maybe we can each give our version of it. But why do we count legs?
because it helps you understand where you are in the market cycle and how strong the market cycle is. Um, so here, we had a parabolic wedge, one, two, 1, 2, 3,
Yep,
and
I
and
agree with
then
that.
and then this is a micro wedge here, and that corrected down to leg two. So expectation met, and then continued, and then we got another wedge, and so all of the wedges are breaking out in the direction of the trend, which is obviously the low probability thing.
And a wedge, and if we think about that, a wedge top is you have a bull breakout, and then you have two pushes up, so it's the start of a channel. Channels evolve into trading ranges. And James, if you can point at bar 42 to 40 to 42, that's
Mhm.
actually the evolution into a trading range. You had a rally up to 19 that arguably could have reset the count. Bar 19,
Mhm.
you had a rally and then two small pushes up, and then you sold off to bar 40, creating a trading range. So that's the
Exactly.
evolution of the market cycle on a smaller time frame. You had a bull breakout, two more legs up into a wedge. The market formed a trading range, and then it broke out to the upside again. So to James's point, you had a lot of breakouts of wedges. Ideally, a bull breakout of a wedge is actually low probability because a wedge should convert into a trading range. But when you actually look at these charts on smaller time frames, you'll see that these wedges are actually pulling back for two legs and forming a trading range. The patterns are so small and minor that it's just continuation patterns over and over and over. And one thing worth mentioning is when you're in a trend and the market evolves into a trading range, the expectation is continuation. So James, what are you
Yeah.
doing right here?
I was going to show an indicator that I wrote that looks at implied wedges.
Really?
So, so if it identifies, so if you don't have a spike break to create, like if you don't have a trend line break in a
Mhm.
move, it'll identify whether that move is generating enough pullbacks within it to create a wedge on a lower time frame. So this was also a an implied wedge here, which ended right here, got the trend line break, and then obviously trend resumption. Um,
Mhm. Makes sense.
and it can be used in a variety of ways. Often, what will happen is it will precede trading range behavior. Sometimes because like if you think about an implied wedge, it is only happening on the lower time frame. But once you have a wedge on a lower time frame, typically you're going to start seeing pullback on your trading time frame. And as a result, then you can start to prepare for either trading range sideways or pullback behavior. And then obviously still expecting trend resumption. Sometimes it results in entire complete reversal, like we saw here, down to the implied wedge low and then reversal.
Mhm.
But here, implied wedge and then just trading range behavior before continuation. Here was implied wedge and then trading range behavior. So it
So is it
is.
fair to say that wedges evolve into trading ranges
I mean, I think that
on
this
almost
is
every time?
on yeah, and being able to be aware of it's Al talks about the three push pattern, and that's basically all this indicator is doing is looking at three pushes and but not on the trading time frame. So
So then to tie this back for a second, what James is getting at is the reason we have to understand a breakout is you have to have a starting point or a line in the sand as to identifying the market cycle. If you can't identify it, if you can't have a starting point as to what the breakout is, how do you conclude what the wedge is? Where's the bottom of the wedge? Where's the channel? Where's the trading range? Because the single most important thing in all of this is understanding the leg count, which is really what that means. And James, you tell me if you disagree. Really, what that means is understanding where you are in the market cycle. And the market cycle could be over the span of 100 bars. It could be over the span of where bar 42 is, that red vertical line. That's over the span of what, 5, 6, 7, 8 bars?
Mm-hmm. Yep, it's probably counting from here. Actually, no, it would be here. This is
So even 4 or 5 bars.
This would be 1, 2. So it'd be 1, 2, 3, and then this is the confirmed wedge on this.
So your indicator is saying that the market cycle completed in 5 bars.
Yep, and then you're looking at at least as many bars of either trading range behavior prior to a reversal, typically.
Mm-hmm.
So like here you had a significantly longer. If the bars continue to be colored after the wedge completes, it just means that you have a very, very tight channel on a lower time frame. And then whenever that breaks, typically you're going to see trading range behavior for at least half as many bars as you saw in that this band. So this is 6 bars. We ended up with 5 bars of sideways price action before continuation. So
makes perfect sense.
But no, I mean, I totally agree that the counting legs helps you understand where you are in the market cycle so that you can properly deploy whichever system you're prioritizing. So early in the market cycle, you want to be trading for breakouts. So not necessarily buying the close or selling the close, but if we know that most breakouts have at least some kind of pullback, whether 30, 50, 70%, depending on the strength of the breakout. Trading the breakout doesn't mean, just entering at the market. It can mean a bit more strategic, entries and a bit more nuance. But I think that when you get to these later legs, like, this is a strong breakout with a micro gap here, but it's all starting from this doji. Are you going to buy Are you going to buy the close here of leg 3 that starts from a doji and has a micro gap?
Of course not.
That's a climactic leg, right? And if you're counting legs, then this is a fade.
Absolutely.
And then this is a leg count reset. So then you had 3 legs here, big breakout. Then you reset your leg count and start again. So that's kind of what I was thinking about, and thinking might be really useful for folks to consider as they're either developing their own systems or considering starting to develop a system, is really prioritizing the breakout portion of the market cycle.
Because that is our leg 1 in essence.
It's a leg 1, and it's trading for the leg 2, and it's helping you assess leg 3, and it even gives you the opposite trade in legs 3 and 4 under proper context.
So James, if you don't, I'm going to share something really quick. Since you just said that.
I'll stop sharing.
Oh no, you're good. Because what you just said, how it gives you the opposite context, is a great example of this right here. Nice. So this is right here, up here. We basically have a wedge, and there's several ways to draw it. But either way, we had a breakout sideways, another breakout sideways, a third leg, breakout sideways, 2 or 3 legs up. But anyways, you're in a bull channel, and bull channels evolve into trading ranges. So bull channel, always a bear flag. We had a downside breakout right here. This is leg 1, and it's pretty strong, breaking below the moving average. What James is saying is being able to identify this right here is important, because it resets the leg count, and leg one has a pretty good probability of getting a second leg. It's got a very good probability of getting a second leg. And the question is, you can often get a pretty big second leg and sometimes a big third leg. But if you're short, look how big the second leg down was. It was much bigger than the first. And what James just mentioned is if you can leg count and understand where that third leg is, here it's a parabolic wedge bottom. And if we look right here, this is technically a third leg down. You've often heard Al talk about how inside bars are often final flags late in the move. And that's generally because it's a third leg down. So look at the boxes 1, 2, 3. Al, when he marks his chart, would often say that traders should buy above this bar right here for a couple of legs up. What James is saying is if you can identify the third leg, this bear breakout is actually a fade. So it's not a sell, it's a buy, or you can buy the close. And it's hard to see. But if you can look at this chart right here, if you can look right here, and James, you can see my cursor, right?
Yeah, absolutely.
Notice the open of this bar went a couple of ticks below the prior close and immediately went up. And that's a great example of it being in the third leg. And there's lots of examples of this right here. This is that same chart. Strong bull breakout. It's consecutive bull bars, barely breaking above the moving average, but it led to a couple of legs up. And one more. Here's a great one. Big bear bars, but it's following a gap up. And this might be for another discussion. Whenever you get a big gap and then big bear bars on the open, in general, you're better off. Really, most traders should not trade the opening range. At least wait for 6 to 12 bars. James, do you normally watch the open?
I watch it. I rarely trade before bar 6.
Why is that?
Because most setups fail. Most directional setups fail. And which is one of the things I was alluding to today is, the strong bar 1 is often a fade, and then a scale in as, trade for a reversal, because the open reverses more frequently than it gets a trend from the bar 1.
Makes perfect sense. And even right here, big violent looking bear bars. But if we actually peeled this chart back and looked at the Globex chart, this is January the 6th of 2022. You had a pretty strong rally right before this. So this is just a sell vacuum test of the moving average. But look right here. Obviously, this is resetting the count. It's getting an upside breakout. And you can see if you bought anywhere in here, just how far the move actually went.
And what was interesting about the previous slide that you showed was that we also still got the correction to the expected leg 2 target.
Right here, James?
Yeah. So the wedge had a 2-leg correction, right? So from
Yeah.
the lows, you got the 2-leg correction, and the wick on the top of that, the high there, got right back to the leg 2, right? Which is it's a little shy of the high of leg 2, but it's the general expectation. Obviously you have a lot of layered resistance there where people were fading. So folks got out quickly, but that is you still got the expectation for the pullback and transition into trading range. And that is the expectation after the wedge is 2 legs, sideways to up, and then transition into trading range. And, no matter how violent it is, that's still what you're looking for.
100%. And James, do you mind if I show something on the daily chart with what you said about second transitions into trading ranges?
Yeah, no, that's great.
So this might be this. We've seen this on the E-mini for the past, really for pretty much all of September, October, and November. Let me fix this. I hit the wrong button. So if we go to, that's why. Okay, James, you can see this, right?
Yes, I can.
So we had this big sell-off right down here, very protracted pullback. So this was leg 1, pullback. Second leg was the second portion of the trend line, and then a third leg down. And if you think back to what James said a couple of minutes ago, leg 3 is often a really bad with trend direction because 3 legs down, you expect an evolution into a trading range. And look what happened down here. The market quickly reversed up. But to James's point, if you caught what he said about that slide a few minutes ago, here was the start of the channel. So we had a sell off. Here was the pullback from that first leg. And look to the right. Look at the current price level. We're all the way to the top of the channel. So wedges, when you get a strong breakout, it usually gets a second leg down, although sometimes it can take a minute for the second leg to form. And then you often get a third leg, and then you get a reversal up into an overall trading range.
And, Al is really great about emphasizing second leg traps. In the trading rooms, second leg trap is definitely prioritized because they're so enticing, right?
No,
and
certainly.
here you come with these small pullback trend today, accelerating up into the leg 2 high of the bear wedge down. So
And
getting
James,
more
from
and
the
more tenuous.
yeah, and from the standpoint, going back to that start of this conversation about breakouts, imagine if one doesn't understand that this is an upside breakout. Where do you think we're resetting? We have 3 pushes down, 1, 2, 3, breaking out below the bottom of a channel or a wedge, and we're reversing up. And the reason why James is saying that breakouts are so important to understand with your system is I think it's always important to think from the standpoint of risk protection more than anything else. What do you do if you're short down here? So you're holding short here. And remember what Al says, it doesn't matter if you sold all the way up in July or if you were short here, whether you were buying puts or anything. What do you do? Are you just going to hold all the way back to wherever you got short? So by understanding the breakouts and when a breakout's occurring, you can transition and be able to change up the way you're trading, whether that's a system or if someone like Al, who's more discretionary, it's all the same.
Yeah, the late, and actually the example that we had today on the chart in the wedge prior to the pullback and then trend resumption is a great inverse example of that bear wedge, the low, which actually had a micro gap
And
in
James, where
those
was
in
it?
right in there. So bars 31 to, or sorry, bars, yeah, 31 to 33.
Oh yeah, right here. So James is mentioning these bars right here.
Starting from that doji just to the left, a little bit further left. So
I'm sorry. Yeah.
30 doji on 31 up to 33. That's your climactic leg,
Mm-hmm.
and it has a micro gap in it. So micro gaps in leg 3s, at least. So I did research on I1Rs, which I talked about, as well as micro gaps as different ways of defining strong legs. But getting strong legs in legs 3 in third legs is an inverse signal because it's typically climactic. And so
Certainly.
we saw the same thing in the daily chart you just showed, which was actually we had a micro gap in the final bar of that push that was a trend line overshoot on the daily chart down into the lows, which we just reversed from.
So James, so just help everyone real quick with micro gaps. Why are micro gaps so important if they happen in the third? A micro gap is a sign of strength, obviously.
Mhm.
So when you get it in the third leg, what is that telling us?
It's telling us that it is climactic, that everyone who hasn't been buying or selling prior to that point, well, not buying or selling, so buying if it is a bull move, selling if it's a bear move,
Sure, of course.
has is finally entering, and so you're
Hmm.
getting climactic price action, and that is almost always going to, I mean, 75% of the time, it's going to reverse,
And
at
it's
least for the move down to develop the trading range.
Certainly. Yeah, that makes perfect sense. And we go back to today, what James is talking about right over here. Bull breakout, small micro gap, but this is a wedge. That's what James is saying. 3 pushes up, 1, 2, 3 in an already overdone small pullback trend. When you get a micro gap in the third leg, increased risk of it failing and becoming exhaustion.
And there were actually 2 micro gaps. So it was the micro gap between 31 and 33 and the ones between 32 and 34. So
James is saying right here, if you can see my mouse, and then right above here. There's 2 of them.
yeah, so this kind of gets back to the idea of the same system generating inverse signals. So if you see this developing, you can sell the close of 33.
Mm-hmm.
Yeah,
Scary as that would be.
Exactly, and this kind of gets back to I don't know how many folks read the essay that Ali wrote on the BPA website, but
Let me, James, yeah, if you don't mind, I'm going to actually keep talking about it. I'm going to bring it up.
One of the things that he discusses is practice, and I think that even for folks who don't trade on NinjaTrader, it's totally free to use their market replay feature and just go in and trade, just practice. So if you want to develop the muscle memory to fade strong moves under good market context,
Mm-hmm.
then that's probably the best way to do it, because it's going to be really unnerving to do it in live markets. And once you have the muscle memory, it just becomes, second nature.
But this is what I'm going to actually do for the people that are listening. This is the link to Ali's article that he wrote. And it's quite a long, it's pretty extensive, but it's exactly what James is talking about. How do you how do you really learn something and the process it really takes? It's a really good article. And you can see it's not short by any means. So it's very well thought out.
And I think that anyone who has experience practicing anything has probably similar experience that they can translate to this process. Anyone who plays an instrument, for example, you never started playing an instrument and just got up on stage and started performing. Like, that would be just bananas. That would be terrifying. As someone,
you played an instrument, didn't you, James?
I play 3 instruments, and so
I was gonna say you're pretty musically gifted.
The idea that like you would ever get up in front of a group of people and start performing, which is what live trading is. You are being assessed on your skills in real time versus going to what all the old jazz players call the woodshed, and just practicing and locking yourself in a room and practicing for hours and hours and hours. That's the opportunity that we have with something like a market replay, or dissecting the charts and developing a system, where there is no pressure to perform. It's just really getting that understanding and the muscle memory, so that when you do have to perform live, it's you don't think twice about it.
Mm-hmm. Absolutely. Yeah, that makes perfect sense.
So yeah,
but it also it takes a long time.
Yeah, it takes a lot of practice. Go in and.
But you can't learn an instrument. You can't learn 5 instruments at once, can you?
No, unless you're Prince. Prince can do that.
Sure. But you take one piece of an instrument and learn it over and over and over.
Exactly. Yeah, no, you don't.
And here's one. So I can pull it up here. James, maybe this might be good. There's a couple of questions here. I'm going to pull up there's some slides Ali made for Systems Academy that talk about, let's Let's just pull up.
I apologize. I had the window for the private chat open, and I was thinking, it's like, man, it's like I feel bad, like it's just us, like
No, yeah, no,
riffing, like
it takes some
there was
time.
like
So let's pull up. Let's pull up. There's a certain slide, and James, you know the one I'm trying to. It
which
is
one?
the
Sorry.
one. Here it is.
Okay.
So let's just maybe a couple of these can answer some questions. So James, the difference between these two examples right here. One, when I think about the musical, trying to learn an instrument, there's got to be a systematic way to, what's the first instrument you learned how to play?
Alto saxophone.
Saxophone.
Mm-hmm.
So how did you go about learning it?
That I learned started by ear. My mom was a good singer, and so she would sing, and I would just copy what she was singing on the saxophone. But then I learned to read music.
Very interesting.
Yeah, my brother's old saxophone.
So let's talk about breakouts for a second. If one is going to get really good at understanding how to trade breakouts, what are some filters? Obviously, this second portion over here, what are some of those main filters that one would need?
I mean, the first filter is context. So always context.
And if it's always context, that kind of gets into that trader's experience, doesn't it, a little bit?
It does.
So that's where it gets really tricky with discretionary trading versus systematic is what people don't realize as far as how do you really understand trading from a discretionary viewpoint? Like how is he able to read a chart so well? The experience level is obviously 30 years. And that takes a long time to really understand that. So if we were going to take context, what do you think? What are some easy, moving average or?
Yeah, I mean, I think that when you say something like system rules, you restrict the context to very specific expressions of like let's say the market's in a channel and you're trading a breakout system. You're looking for not just a breakout bar, but a breakout and follow through. So breakout and follow through, and the IBS of the breakout signal bar has to be above a certain threshold. So you would have your breakout system, and then you would have a few filters like IBS or being above or below the EMA or the angle of the EMA or the leg count. In my research, the most effective filters were leg count and whether the breakout was breaking out from an opposing. So if you're looking at generating second leg signals and trading for those really high probability second legs, then breaking out from opposing swing points of previous trends in the other direction. However, if you're just trading a channel, then you're looking for pullbacks and possibly even trading for the third leg, which is lower probability. But if the trend is strong and the channel is has a sufficiently steep angle, then it's still a statistically significant setup.
So you just said something really interesting, and I remember you mentioned leg counting, how you did a study, and I don't want to rephrase your words, but you said leg counting significantly, in simple terms, leg counting significantly changed the results of your study, right?
Yeah, absolutely.
And do you remember it happened all the time in the class, especially in the beginning last year? People would be presenting, and Allie would say, and they're gathering their data in the spreadsheet on breakouts or micro channels or whatever it is. And Allie would always mention, are you filtering legs? And the point with that is when people started to filter, and basically what Ali told everyone is by simply ruling out the third leg and focusing on the first two, if you're looking at breakouts, you're going to increase your probability dramatically. If you can filter the first leg, you're going to really increase your probability in a dramatic way. So,
Mm-hmm.
again, let's remind everyone leg counting. Leg counting is understanding the market cycle of that range of bars, right?
And to that point too, it means that, say, you might not participate in a really strong small pullback trend, once it goes beyond 4 legs, which they often do,
Hmm.
simply because your system prohibits you from, trading in the direction of the trend after leg 3 or 4. But that's fine because small pullback trends happen, less than 5% of the time. So,
They're pretty rare. Yeah.
you what it's not going to have a statistically significant effect on your profits at the end of the year. It's just you'll still get some trades on those days, but you wouldn't be trading in the direction of the trend with the small pullback trend all day long.
Hmm.
Maybe you would once get more comfortable with your system, or in the case of today, if you have a method for resetting the leg count on sufficiently strong breakouts in the direction of the trend, then maybe you could. But yeah, it's a. I mean, I think it's by far the most effective filter for any system.
And James, would you say if you can understand where you are in, let's say, if you can understand you have a breakout and you understand it's leg one, does it really matter too much if you buy in the context makes sense? Leg one should get a second leg. Does it really matter if you buy the close, buy the pullback, or do both?
I mean, you can do all of it. You just have to have. I mean, and this is part of the system design process.
That's
Is you
it
just
though.
have to
But
have
you
the right
can.
position sizing.
So if
Yeah.
exactly. So and maybe a different way for me to ask that is if you can identify the proper leg count, it's leg one, the chances of the trade working, whether you bought the close, whether you bought a pullback, go up significantly versus it's the fourth leg in a small pullback trend.
Right. I
One's
mean,
completely different.
exactly, and it's also uh, once you've researched your signal and you understand the nuances of how of what they imply for as far as pullbacks and the expectation of their performance, then you can get a lot more creative with the way that you enter. Because, like, for example, with I1Rs, um, they pull back to at least 30% of the I1R range more than 70% of the time.
Oh,
So,
absolutely.
30% pullback is in a much stronger trend, trending like one. So breaking out from more things like the EMA and previous swing points and yada yada. And the bars are bigger, and so you don't expect as deep of a pullback. But even when you do get a 50% pullback, which is very common, then you're still, like, if you entered at 30 and you entered at 50% of the range, then you have a slightly larger position on, but you know how to manage it. You know where you expect the measured move targets to get to, and how to assess them and where your stop goes. And so, yeah, I mean, if you're counting legs, you also have built into that your potentially, depending on how you do it, your stop locations too.
Because the stop risk and stops are a part of a system, right?
Yeah, and they're
Obviously.
often dictated by either the signal bar or the entire leg. Like if you're trading like breakout legs or breakouts from, sorry, trend resumption from leg one breakouts, then it's you know not necessarily advisable to have your stop just below the swing point of the leg, because you can get legs that do pull back just below that, run those stops, and then transition into a trading range, or even sometimes get full trend resumption. So it's
Hmm.
better to have a small measured move for your stop below the range of the however you're measuring your signal. But still, like, all of that's built into the way that you design your filters and your signal.
100%. And maybe this might be what the way you design your filters and your signals. That might be a good transition. There's a couple of questions over, does Systems Academy teach system building? And James, it's fair to say that Systems Academy is designing systems, right?
Indeed.
From A to Z. And when I think of a system, there's two major things I think of when I think of a system. There's several layers to a system, but when we're talking about just in very simple terms, you have the mechanics of the trade or that setup, which is the system. That includes everything from the filters, what it is, stop placement, and where your target is, your risk. But then the whole other side of that piece is the actual management or the risk management. In other words, the position sizing, the capital at risk, all those little pieces, the exposure of that actual system. But this right here, really brought up this program milestones, because this is pretty much all, it's at least a pretty good snapshot of everything that's discussed in Systems Academy over the course of a year. And each one of these is a video that everyone starts with watching. There's 30 hours of videos in the beginning. But James, do you want to say something on this? I'm sure you have a lot on this particular topic.
I mean, I think all of the videos, at least in the theory track, which is the stuff on the top row there, number to the left, to the right of that number one, that's basically the preparatory content. Basically everything that folks go through before they start designing their system. And I think a lot of people have gone through and designed, workable systems, along many of those parameters. I think, obviously, we get it. Ali has significant depth, and the statistics section in the foundations was kind of perfect. I think that it's placed perfectly in the larger structure of the course, and really helps provide the context for understanding all of the other components that we build on afterwards. But when you get to the build process and the optimization, position sizing, and financial strategy, I think those are the things that even folks who have gone through the effort of developing systems don't really spend enough time with, because like you were saying, you can buy the close of those strong leg ones and then scale in lower. But you can't do that, if you don't understand how much risk you're taking and what the risk tolerance of the system is and what the SQN is. Like, I mean, all of these, related components, I mean, they have positive feedback loops, that they create with each other. And if one of them is not properly accounted for, then the whole system doesn't operate the way that you intend. And so the real delicate balancing act is making sure that all of these are calibrated properly. And then once they are, you can go into your market replay, practice it, and make sure that it's just muscle memory at that point. It's like playing a solo.
And the one thing I want to say with what James said, everybody's built some variation of a system. I'm going to trade breakouts in second legs, or I'm going to wait for a double bottom or a double top on the open. That's all a variation of a system. It's not that hard to design a system, but the challenging part is what James just mentioned: optimizing and actually designing an actual strategy behind it. One thing James alluded to is that calibrated expectancy, or calibrated expectation is really what it's called. And that is, what is the expectation behind the trade? If you don't understand, as James said, sure, you can buy the close or you can buy a pullback, but you have to understand how that trade is supposed to play out. Because if you don't understand that, you will not understand what the risk parameters truly are. It's kind of like Al says in the course, nobody should risk more than, most people shouldn't risk more than 1% on a trade. Well, that's 1% within what context? If you can risk 1% on a breakout, but the calibrated expectancy or expectation is, understanding, well, when are you wrong? You buy a breakout, what is supposed to happen in this situation? And if that doesn't happen, when is the opposite happening?
And to that point too, if you know that the opposite is going to happen 25 to 30% of the time, then under those conditions, what is the strategy for getting out without a loss?
Mm-hmm.
It's certainly not entering with a full 1% position, at your initial entry, because then you can't possibly get out without a loss unless you're willing to risk significantly more than 1% in order to get out, break even.
Certainly.
So it's, scaling your entries, likely quarter percent, 0.5% entries, so that you can recover potential losses from adverse moves, which are typically recoverable in most scenarios.
And what James is getting at is most people really like to trade significantly smaller and build positions, scale out of positions, and scale into positions depending on what the market does. So let's see here, if there's, and feel free to ask questions. I'm scrolling through to see what questions maybe we haven't answered. Another thing to point out with all of this is right here. One of the problems, I would argue that Al's course is probably the best price action course out there in terms of just sheer information, hands down. And you can look at his books. I think I forget how much. I think there's 800,000 words in
The
his three
books,
books,
the
or like
books are
600,000, and that's
I
just the books. And there's
I I love the book so much. I mean, I also think that he's one of the best writers of like
oh, certainly.
in financial literature I've ever read. He's funny, he's clear. Like there's nothing like that.
Hmm. And even with all of that, when you think about a course and there was a lot. I mean, there's the current Brooks Trading course actually has been that it's been remade. 2017 was the new course, but the original course was made in 2013 or 14, and that was a couple of years after the volume series of the books. The point is, Al has spent almost a decade thinking through how to explain price action. And even as well as the course is, and as much work as Alan, Richard, and everyone put in, one of the biggest problems with trading as a whole is this top portion. The reason why there's a lot of people that won't finish Al's course because it's just too long. And part of the reason they won't finish it is simply because they don't have a structure in their life or the discipline to finish it. They don't have the accountability to finish what they're learning. The other problem is supervision. So with all of this, one of the reasons building systems can be helpful is you can give yourself goals of what am I trying to build. If I'm going to build breakouts and second legs, maybe I can devour all of Al's information on breakouts, build some sort of list out of it, go through the market cycles, understand leg one, and then piece it together. But if I take all of Al's video course and just try and learn everything at once, I'm just going to watch video 1 to video 60 over and over 40 times and hope I understand it. That won't work because you have to actually build, you have to understand what you're doing. And then, as James said, apply it in a simulated environment, market replay over and over and over until you understand it where you can execute it in a subconscious way. And one of the goal with Systems Academy is, I mean, it's right here, understanding a system, building the system, and actually taking the time to fully complete it. And then the end of the day, once you have your documentation, can you actually duplicate the results of the system?
I mean, I think that the part where you're saying just watching the videos over and over, doesn't
And
I mean,
there's a
it's
benefit to
nice.
that. There is
I mean,
definitely a benefit to that.
I've done that. It's wonderful. And there's definitely value. I think the places where I saw the greatest payoff in Systems Academy were in spending time coding and explaining, price action principles to the computer because it's like talking to a baby, and so you have to be clear. But second was in doing the manual back testing, because the manual back testing reveals all those nuances that determine how you structure trades, how you manage them, the invalidations, all of the things. It helps you identify filters. These are all the things that you're not going to get by just rewatching videos.
Mhm.
The rewatching the videos will point you in the right direction, and then each of us need to figure out really for ourselves, what makes us feel most comfortable when we're trading, and then understand that, at the deepest level, so that we can remain comfortable and in control of, our positions, so that we can manage them properly and, um, come back the next day.
100%. And, you know, what I'll say as far as this comment takes 2 to 3 years just to get good. I think it takes 2 or 3 years. I mean, you could argue less than that to really understand a lot of Al's information, but I challenge everybody. There's that link I posted right up here. Let me just find it really quick because I want to hit on what James said. Here's this link. I really would like everyone to go to that and just read the article. And it's actually on Ali's website as well, quantsystems.ca. But going back to this comment, it takes 1, 2, 3 years, I think, just to become fairly proficient with, you can bat back and forth. Let's say it takes a year and a half to 2 years to be able to bat back and forth with Al's information. You can talk about a major trend reversal. You understand what it is. You understand minor reversals. You can basically explain the video course to a degree. But then, to James's point, there's another layer of, you have this encyclopedia of information, but how do you use it? There's people that have the encyclopedia of charts, and they purchase it, they get it from Al. It's got 6,000 slides. They have it, and then they don't know what to do with it. One of the reasons they don't know what to do with it is because they have not built the understanding of, what does the open do? Or on the open, when I'm trading the open, what do I look for? When you get a big gap up, what do I look for? So you can have this wealth of information, but as James just mentioned, what helped him the most was actually back testing the idea. It was taking an idea and spending a lot of time thinking about that one concept. Then he started to build those, neuro pathways where he understood what he was doing. But excuse me with that. Anyways, the point I wanted to say with that is, if you want to become Al and trade like Al, Al's been doing this for 30 years. So everyone has the false expect. It's easy to get the false expectation of, I want to be Al in 5 years or 4 years. And that's like, anyone telling themselves they want to be the LeBron James of basketball in 2 years or 10 years. That's just not going to happen. But the fastest way is actually understanding 100% some form of what you're doing, whether that's a breakout, how are you trading exactly? And that goes
Uh,
back to this slide here. This part, to be able to just trade from a discretionary standpoint and just do whatever you want, takes a very long time. I had a conversation with Ali. I think it was in Orlando when we were all there. And one thing Ali told me is, a trader like Al is an artist. They trade based on their expression. And when you think about it, that's backwards, because a lot of people, Al says don't trade with emotions. But if you listen to the video course, hallmark is the confusion is the hallmark of a trading range. Or if you feel that there's urgency behind the move, you need to buy, or you need to sell if it's going down. One thing Ali mentioned was, a very good trader that's discretionary is an artist. They can they can basically take a canvas of the day and paint however they want. And you'll see that when you listen to someone like Ali. You'll see that when you listen to someone like Al. They can just trade based on how they want to trade. But if you listen to Al for a long enough period of time, you'll hear all these little sayings that he mentions. Those are systematic ways of him saying, I don't want to be the first person to buy with a limit order, or, I'll let someone else make money on this trade. Small pullback bear trend, I only want to sell. Small pullback bull trend, I only want to buy. Tight trading range, I don't want to do anything. All of those things that he says keeps him geared towards trading in a certain direction.
And to the point here, the time consumption comes in two layers. I don't know if you want to click on that comment. First is digesting the info. Second is implementation in real time. I mean, I would even add a third in there, because I think the practice model is really useful. First, it's like in the practice model, it would be listening and understanding what is happening. Say, if it's trading in the video course, or say for music, the listening to a Freddie Hubbard trumpet solo over and over and over again, and then understanding how to practice. And so understanding the key, understanding the scales that you can play inside of that key, understanding the related keys and how you can play the scales in those keys over the bass key, and then organizing your ideas around what you understand from the original. So that would be studying Brooks, BPA, and then doing intentional practice like Ali talks about, so that then you can go and you can perform live. Because until you've done that second part, the digested information is really not functional yet. It's understood lightly. It's not understood deeply. And it's that practice that makes it deeply understood. And then you can do a lot more live.
That is 100. I could not agree with more with what James is saying. And this, I just feel like this is a natural transition into what you just said. And, James, do you want to talk some about this? Or I can just the overall, this is a slide Ali made. He started with it he's always had it in Systems Academy, but he would talk to those of you that are in those pro trader mentorship sessions on Saturdays. This is everyone's expectation of how long does it take to succeed to really figure things out. And it always takes a lot, significantly, as everyone knows, significantly longer than everyone realizes. Everyone's heard of the hockey stick analogy in any sort of business, where it's obviously towards the end where things become more parabolic. But one of the keys with systematic trade, you have two choices. You can just trade whatever you think you should trade at that exact moment. And eventually, if you studied long enough, and there's a caveat to that, if you study and make enough of the right course corrections through time, you'll figure it out. But making course corrections is key there. Eventually, you'll figure it out. The second portion is systematic, being methodical with, I'm going to trade this exact setup. I'm going to fade low ones and high ones, or I'm just going to trade high ones and low ones. And I'm going to figure out, when should I fade them? When should I trade with the trend? Then they have a much better shot at becoming profitable with that one setup. Sure, you're not going to get 20 trades every day with that one setup, but you could at least become very proficient with that one thing. Or I'm going to trade breakouts in the first leg to get in on, trade the breakout for the first leg to get a second. Doing that is going to get you much further.
And, hey, Mike.
Yeah, I was going to say, hey, Mike, you've seen this slide before. You've actually seen this before, because Ali drew it in those classes.
Yeah, this was a hand drawn chart.
Yes, they were hand drawn. But I want to see, there's a few more in here.
While you're looking for that, trading high ones, low ones, high twos, low twos, it's fantastic to be able to codify a system around something like that, because anytime you have a leg, you're going to have a high one, or a low one. And then, if you get a leg two, so like, if you're getting a two leg pullback after a strong leg one, then, that's your high two, or low two, obviously.
Yeah, James, maybe we can see if we can find an example or two of
Sure. I
just
mean, well, we got the triangle open there, and then the breakout and high one, which so breakout, pullback, high one. I guess that's what bar 37.
37 right here.
Yeah, 37. Um, which never gives a good high two. And so, fading that pullback after the triangle breakout. I mean, that's an interesting one, because it's a test of the apex of the triangle too. And so
100%.
once you've tested that on a strong breakout and a vacuum sell, that might be one of, if you're trading for high ones and high twos, might be one of those scenarios in which you don't take the fade, and expect a high two. I
Absolutely.
haven't studied them, so I don't know what the probability
No,
is
but
for
that's
that.
James, you're totally right, and you can see you had a bear breakout, so maybe it's always in short. It's debatable, not quite. You had a bear bar 2 bars later, so there's a bear bar right here. And if we look at this, that's a low one. Even though it didn't
Mhm.
trigger, in theory,
Right.
it's an implied low one on a smaller time frame. But look what happened a few bars later. We went above it and then we tested it twice. So a trader who sold this low tick, someone was unfortunate enough to sell the low price of this bar. And then it rallied and it still retested it. If we go over here, this is a low one short. This is a low one on 67, but it's a bad low one. It's a parabolic wedge, so you expect two legs up. So leg one, pause, leg two. But even if you sold this low one and sold more higher, it still retested. Well, actually, it retested the low one several bars later.
Well, and in that case, I think that's a good case for where context. I mean, I think
We'll go back to it.
uh, trading high and low ones as fades requires a really, really great read of context, because if you're getting those high ones or low ones after parabolic or after complete wedges, so obviously we had the complete bear wedge and correction, the odds
Hmm.
of getting two legs of correction are good. And then obviously we had the test of the leg too low there. So then you expect at least more trading range behavior and two legs. So it would be I would be hard pressed to sell that low, that low one, with the expectation that it's a weak low one, so odds of seeing a low two are even better. And yeah, so
Oh,
anyway,
absolutely.
it's just I think that low ones and high ones as fades are great setups, but require a really strong read for context before they can be done well.
And let's just say something about stop entries for a quick second. I challenge anyone, go back on the Brooks Trading Course website. So go back to, let me find it here. I want to show everybody something about stop entries. So I'm going to go way back on stop entries. So this is a time in 2020. And there was a period of time where Al would mark so many stop entries on a chart. People were basically asking Al and Richard, how can there be this many stop entries? These trades, if we find one that didn't work, let's find an example. You bought here or here. Well, technically these failed down here. But what's interesting, when you look at most stop entries, or if you bought here, it pulled back, went up, and failed. Most stop entries, if we can understand what kind of follow through you actually want to see, you notice that most stop entries actually allow you out of a trade. If you bought above this bull bar right here, it's not a great bull bar. It went sideways for 2 bars, bad follow through, and someone could have gotten out on the very next bar. If you bought anywhere in here, you could have gotten out maybe when the market failed to break above the moving average. The point I wanted to make with this, more or less, is when you look at a lot of stop entries on a chart, they often lead to sideways trading before they immediately fail. So, for example, let's say you were long, you bought the close of this bar. Well, the appearance of your entry bar is a doji. But if you actually go back, if you were watching the market at this point, this bar did not go up and down in 1 second. It rallied, hesitated. It spent a lot of time up here, a couple of minutes, and then started to sell off. So part of that calibrated expectation of any trade is understanding what should the market be doing. So if it rallies above a new high, if James is building a system on breakouts and he knows that, okay, he's looking for breakouts above trading ranges and the market breaks above it and starts to stagger and then starts to pull back, eventually he's got to conclude it's a trading range. So the point with that is the better one can understand what the market should do, it's starting to rally and then it's starting to reverse. If James understands it's consecutive buy climaxes, it's top of a channel, maybe it's several wedges, and that the odds favor a second, maybe this whole thing getting a second leg down, you might have someone who's being willing to be a little bit more aggressive with selling, taking a chance that this happens. So there's actual this is people, I'm sure there's some news event you could claim, but there's a logical reason why this bar appeared. And all of that gets into really understanding the why or what the expectation should be.
Agreed. Yeah. I mean, the question here doesn't now put scalp trades on the review.
Sure. Those are all scalp trades. But good scalps are, if you understand swing trading well, you can do both. You can scalp, you can re-enter, you can hold on.
Yeah, I mean, I think that is kind of the boil this all down to first principles is if you are confident where the market cycle is, then you can basically remain, and this is something that Ali talks about often.
And James, can you remind everyone what first principles is for those that don't know?
Sure. First principles are basically your something that cannot be reduced further. So when you are at it's like you have axioms in math. So when you have an idea that is a foundational idea that does not depend on something else for it, then that's a first principle. So breakouts are a first principle. And when you have when you approach the market cycle from a first principles perspective, it allows you to do what Al always talks about, which is it staying basically if there's a tight trading range, I'm not doing nothing. If it's a small pullback trend, I'm only buying. Like it allows you to easily come to these conclusions. And I think maybe next time, Brad, you could share one of your flow charts, which kind of walks folks through the way you can chart that for folks who aren't going to code. Basically, it's code on paper, right? You can do the same thing and just walk yourself through that logical process and come to the same result. So by remaining, by starting all of your thought, your work and your thinking from first principles, you never really drift far from where the market cycle is because you're always attuned to what has just happened and what the expectations are for what should happen after. And if the things that you don't expect happen, then something is changing. And if something is changing, then you can recalibrate your expectations differently. However, if everything does develop according to expectation, then the market is doing what the market cycle should be doing. And so it
100%.
allows you to have a positive reinforcement mechanism built into the market, which is telling you how to treat the market, without you having to impose your own ideas on it, which is where I think most people kind of go awry.
So that first principles concept is, just to reiterate, if I'm a viewer and I'm listening to you, that is that foundational. I know this is true with beyond, without a doubt about the market, whether that's a breakout or the market cycle. Breakout forms a channel, then it forms a trading range. Could all that be a first principle?
Uh, well, the first principle is that the market moves in cycles, and the cycles are defined by breakouts because the breakout defines the beginning of the cycle.
Perfect. So then, exactly. So
Yeah,
then, a breakout is that reset of a cycle,
exactly,
and then the breakout evolves into a channel. So the trading range is really the end of the cycle,
exactly. Yeah, it's breakout mode. It's
which is exactly what Al. When you think about it, that's exactly what Al says in the course.
yep,
It
and
could be
and
the evolution of the market cycles. The market evolve is a trend or a trading range, so it's evolving from the trading range into a breakout and then a new market cycle.
and it could be just 2 bars. Like a final flag is a trading range. It's typically like you said, it can be just an inside bar. And in that case, it's 1 bar is the market cycle on a lower time frame expressed on your trading time frame. And so, yeah,
100%.
and because it's all fractal, I think that price action traders have a distinct advantage in being able to apply the same understanding, across all time frames. Yeah, and once you can read a chart at a glance, I think that it's incredibly powerful because you can trade tons of markets, say on the daily time frame, you know, trade lots of different positions really well with very little stress. There's lots of opportunity to do really creative work.
Absolutely. And there's another thing I want to say. Trading is all about building on what you're learning. And someone asked this question: why do you guys think Brooks is
Mhm.
overrated? And I want to show one thing. Give me 2 seconds here.
Someone commented on while he's grabbing this. Someone
There's a
commented on
reason
my
I pulled it
son's
up.
art. So I'll show you my son's art while Brad's getting something more interesting. That's what's behind me.
This, I'm going to try and do this. Most of y'all have seen this, but I'm going to just compare. This is every one of Al's books that he's written. You can see the thickness. And as most of you know, this is Trading Range book. His entire book is about this that covers, that's an average page without a chart. So as James mentioned, Al is a very good writer for being able to write all this. One of the reasons he's overlooked is because no one wants to read all of this information. But the reason I grabbed these books is I actually wanted to think, if you think about, if you really want to understand discretionary trading, how much do you understand of all of this? Do you really, have you read the books? And if you're wanting to understand discretionary trading, have you really finished the video course? Because just going through that video course of Al's is, that's one step in an overall process, but it's a process of many steps. And when we think about, James, you've taught students before, right?
Yeah, I used to teach literature.
So you
Yeah,
taught literature, and so there's a path. How long does it take for someone to learn a concept?
I mean,
I know it varies depending
yeah,
on what the
yeah, it
concept
depends.
is.
It depends on the student, and it depends on the concept. But something as kind of straightforward as relationships, organizing your thinking so that, like, say, the introduction, and this is actually something that Al is incredibly good at, is organizing an entire chapter around an introduction paragraph, where basically the every sentence in the introduction paragraph can have a, like, if you split the whole chapter out horizontally, like on a piece of like rolled paper, you could just draw lines that connect that one sentence to sub paragraphs that deal with that topic, so that logically, as you read, you start from that one paragraph, which has the entire chapter just crushed into it. And then subsequent paragraphs and sections, subsections, are expansions on that one sentence, so that your mind is already prepared for what he's going to deal with later in greater depth. And it's that nuance and that really thinking through. And Al has done all that, that heavy lifting, obviously, but he's thought through everything so deeply that he can cram an entire chapter of like those incredibly dense pages. Those dense pages are just expansions on one sentence that appears in the the introduction, which is like the Big Bang. I mean, these are just incredibly dense ideas, which he then just lets expand. And it's those kinds of things which are very difficult to kind of grasp and deploy.
But that's one can get there just through sheer time and thinking, right?
Yeah, and time. I mean, it's writing over and over and over in the same way that doing market studies, doing setup studies, doing market replay. I mean, they're all the same parallel process, just for a different practice.
100%. So this has been about an hour and 20 minutes. Is there any, definitely longer than we anticipated. Is there any final questions anybody has? We'll start doing more regular ones, but they'll definitely be shorter. And then, what James and I have talked about, we'll start doing more topics, flowcharts, or, maybe something to do with reversals.
Yeah, I think reversals would be a good one next time, because that's kind of the logical extension of dealing with breakouts.
For sure. All right. Well, I guess, James, until then.
Yeah. Thanks for jumping on, Brad.
No, for sure. Same to you. And thanks everybody for listening.
All right. Everyone have a good night.
Have a good one.